story going on this morning. I can think you can imagine, and I'm going through my whole deck right now because I'm trying to figure this all out. But yeah, options by candlelight is a theme for today. If you haven't noticed, we have an outage at the Chicago Mercantile Exchange, CME, and we're going to talk a little bit about, well, why that matters. Nonetheless, pretty interesting development, but should not impact everything else going on in the world today. We'll dig a little bit into that. Really, the core thing here is that you are here. You could be many places this morning, particularly traveling, but this is actually a really important day for equity markets. And, we've had the squeeze that has transpired since last Friday, Japan's stimulus kicking in. A lot of questions about the repo market have abated, and that lower volume has taken us, to levels that a lot of people didn't expect last week. V-shaped recovery coming right off the 100-day EMA. Sunday night, I had sent a note out effectively saying time to cut shorts. Looks like a squeeze is coming on, and here we are. So a move back to 681 on the SPY. That's kind of where I was on Monday. Now the question is, do these funds use the recent strength that we have seen in this equity market to sell back into? That is the real risk, and it starts today, particularly with so much noise around Black Friday. Lots of questions around what's happening with this outage and how market makers and dealers and brokers and everyone else will handle a day like today. So thanks for joining us, because is this a trap day is always a question that we ask. It's got that feeling of that setup that comes, but now the question of more volatility, how brokers and how everybody else will react to this. There was a 2014 technical error that had transpired at CME. It was a glitch that shut down futures trading, demonstrating that a global exchange can go dark temporarily. But what we do know about this outage, which is important, just as we dig into momentum and talk about the current state of affairs, just to let you know, they issued a halt that their data center cooling failure shut down trading on futures and options markets on the Globex platform. The freeze affected a lot of different contracts: equity index futures, commodity futures, FX futures, Treasury futures, and options on many of those futures, disrupting those derivatives traded on CME listed contracts like ES, S&P 500 futures, CL crude futures, gold futures, and Treasury futures. So yes, this does have some precedent to it, and this event is documented as a full shutdown of CME futures trading, an identical precedent, near identical precedent from 2014. What this doesn't guarantee, and why there is some uncertainty, it made clear the outage impacts CME listed futures and contracts. It did not mention U.S. equity traded stocks or ETF options like Apple or SPY or the Qs. That infrastructure for those is not CME Globex. They trade on separate exchange networks: NASDAQ, CBOE, NYSE, ARCA, etc. And that means stock ETF options should not be directly halted by a CME futures platform outage. However, if those contracts remain open, the indirect effects do matter. And we'll be talking about what those effects are after we discuss quickly momentum. Momentum has moved from an extreme breakdown to an extreme breakout in about 5.5 trading sessions. And it is no coincidence that this transpired after Japan announced a massive stimulus package. We have seen this before. We have talked about this before. We have warned about this before. We have made money off of this before. The reality is that the plumbing of the financial system was comforted, and it was all backed at the same time that we saw the strongest amount of insider buying to selling since April of earlier this year. Why does that matter? Well, it matters because what goes up can go down pretty quickly. We have moved to a point where the SPY breakdown numbers effectively went from 0 breakout last week to 0 breakdown this week. And that creates a lot of questions and tensions at this pivotal time for the equity system. Right now, as we look at this, there have been gains, and I have recommended that if you've made gains on a squeeze, you consider taking them because there still are a lot of questions heading into the December trading session. Simply because we have this optimism does not make a Santa Claus rally. In fact, it may create what is effectively a bull trap. That said, if we look at this situation right now, it's a good time for funds to consider taking gains off this week. And if they were already off board due to concerns and questions about the economy, this recent squeeze can lead to selling. Keep a very close eye on key moving averages. Watch the, you know it, say it with me, FNGD, which is back under its key 50 moving average and its 20-day moving average. These things will whip, they will move. Be cautious above the pink line. Be extremely cautious forgive me, over the pink line. Be extremely cautious over the blue line. That is the key line in the sand. And once again, this is where your stimulus came back into play back here earlier this week. We have now seen, again, a lot of questions about um, how these squeezes work and how policy changes work. And many people will look back on this period of time potentially thinking, how did I miss this? It really came down to the policy change by the Bank of Japan and the insider buying, which was, again, the most extreme that we had seen in a while. Real quick, just to note about this story, a data center cooling failure again halted trading in equity, FX, commodity, and Treasury futures worldwide. Price discovery is, in effect, broken for the moment. So do expect some wider spreads, sudden gaps, and forced hedging if futures restart or when they do. You're watching the ES, the NQ, the YM, and the RTY, CLG, CSI, ZN, and again, a lot of different futures. Watch liquidity, expect volatility spikes at the reconnect. I am not paying attention to when they are coming offline right now. I am talking. So we will figure that out. Most people think markets are separate systems, stocks, futures, and options. In reality, everything is tied together. Dealers, hedge desks, and market makers all sit at the center of this. So if one part breaks, the pressure hits the whole system. Doesn't mean that it's catastrophic. It just means that we have to be on our toes and a little bit more vigilant in an environment like this. The market makers are the backbone of liquidity. You know Citadel, you've heard that name probably 1,000 times, Ken Griffin, and the relocation out of Chicago to Miami. Jane Street, another name. A lot of people know it for high frequency trading. Hudson River, Optiver, SIG, IMC, Goldman, Morgan Stanley. They stand in the center of every major market all at the same time. They focus on hedging and inventory, not the stories that people are using to try to trade. They make instant trading possible. Now, I don't know what your feelings are about payment for order flow. That is considered the innovation that made it possible to, well, eradicate a lot of these associated costs with trading. Some people might argue differently. That said, futures matter so much. Futures tell the system where prices are expected to move next. They anchor options pricing, volatility models, hedging strategies, cross-asset trades, and fair value calculations, if that is still a thing. When futures stop, price discovery halts as well. It is like shutting off the headlights on a highway at night. Now, dealers will manage risk on this by hedging stock options with the stock index futures, Treasury futures, FX, ETF baskets, and volatility futures. Every trade creates ripple effects through the markets. We talk about the basis trade quite a bit involving U.S. treasuries and then the associated Treasury futures and how that trade has created this kind of monster that sits in the back of the system and provides ample liquidity to the system and helps suppress volatility. Again, not saying anything's going to completely unwind. It just is one of these things that we don't see very often. And it is worthy of the conversation and a reminder that this really is a delicate infrastructure. And if one person starts to panic unreasonably, then it can lead to more volatility, wider bid-ask spreads. But for the most part, People are prepared for this type of thing. A futures outage will affect stocks, options, ETFs, and bonds, even if they remain open. There is that hidden connection that CME runs futures, CBOE runs options, NASDAQ and the NYSE runs stocks. This is the basic way that things operate. TradeWeb, ICAP on bonds, and FX trading over the counter. Different systems, but the same dealers do sit in all of them. And when one exchange breaks, the dealers can lose the hedging tools and the whole system can feel it. So when that anchor happens, we saw the halt in index futures, Treasury futures, FX commodity, and futures options. It removes an anchor for the financial system temporarily. Stock and options will still open, but dealers have lost a key hedging tool, and this can and will likely lead to wider spreads, a little bit more volatility, and uncertainty. And the way to think about this today is that liquidity may seem poor, but prices may move suddenly. Hedging may be harder, spreads may widen. It is a system of a functioning market, but not a normal one. And when the anchor breaks, everything might feel more fragile. In this environment, do yourself a favor. Don't spend a ton of time panicking. And secondly, if this isn't for you, take the day off, walk away. It's the end of the month. We're moving into a new month. Volatility. Again, you want to be at the center of the action, be at the center of the action. But use today more of an educational opportunity and not as a situation to try to engulf yourself in the semantics of one thing going down. This is a once in a decade type of event. Treat it as so. All right. So 8:45, we're going to skip our headlines. That is shady. We understand. Okay. So, yes, no problem on that, Dale. You got to be prepared for these things and you got to understand the plumbing because the plumbing is kind of how the whole system works, right? There you go. You'll be fine on the SPX. They're showing wide markets. And if you're trading today, and you have a bunch of equities that in any capacity start to show wider bid-ask spreads, go back, like look at volume weighted average price, go back and focus on the stuff that already has ample liquidity. Go back, right? SPX, S&P 500, Qs, Apple, Amazon, focus on those names. Don't go into the quality value names that have bid-ask spreads of 35 to 55 already and try to take advantage, try to focus on that. Learn something new today. Learn about futures. Learn about higher volume trades. Learn about expected moves. This stuff that I'm talking about right now, things like Riot, HIMX, they might see a lot of width today. But that said, let's look at Riot. Riot Platforms is a name that I have said time and time again. I'm willing to buy this at $13 for the long term because my expectation is liquidity will remain ample through next year. So we are looking for a continuation here on momentum in Riot. Now we are walking into an environment where, again, volume has been a little lower in recent days coming off of this squeeze. But if we continue to see this momentum shift, and if we continue to see strength in crypto, then Riot really will be one of the better players in this space. If you haven't already, I mean, I am already down looking at the $13 put for January on Riot. I'm willing to go a little bit lower now and look for a potential spread that I can sell that I would be content to buy this stock. Now, in this situation, going out into January, third Friday, would take us down into something like the $12 put and buying the 10. And what that provides us in that type of trade is $164 to make 36, max return on risk 22%, probability of profit at 80%. So once again, buying the 10 and selling the 12 and keeping a stop here at basically If this hits 75 cents, I would buy it back and I would be out. That would be about a 20%, 25% loss. But looking for equity to continue moving higher, I'm content to buy this stock back down here because my expectation is Federal Reserve, QE, some level of additional support from China, other central banks around the globe. I still see Riot moving higher toward the end of next year. I'm willing to buy it down here. And then I will revisit all of my expectations on the hyperscalers at a later time. I don't think that we are at the center of that crisis yet. I think that comes when the liquidity wall hits, and that's late 2026, 2027. So for right now, I'm looking to take advantage and accumulate some of the more beaten up names in the hyperscaler space. Hymex, we've talked about this. Taiwan Semiconductor, of all these names that are linked to that country, coming off the backside of oversold and really beaten up in recent days. I honestly just like the stock. You can buy the stock too, and you can sell calls on top of it. And on a day like today, is if you want to try to take advantage of something like that, buy a name like HIMX. And if the spreads do go very wide on the options, set it at the ask or set it right below the ask. Because if people are trying to speculate today on some of these names and they're not as well informed on how a day like today can be impacted, buy the stock at this price and sell the $9 call or sell an 850 call or whatever is available and just look to try to take advantage of continued momentum. But by buying the stock and selling a call, you effectively keep that premium, and that allows you to play a little defense in case this stock were to drop back under the 740 level. JOBY was a name that saw a lot of action and activity after it had a huge insider buy last year. Well, this stock trying to bounce back coming off of near-term lows in September, same thing in November. Just looking for a continuation, a possible move back up to the 516 level. Also, same thing, selling spreads to the downside. We've done this a couple of times, looking down maybe at the 10.8 or the 11.9 spreads. If you're selling, looking for a high probability of profit. Remember, we, when targeting put spreads, are aiming for something in the 20% return range, probability of profit around 80%, and an annualized return of roughly 100%. Because the goal here is to find an equity, find a name that we can sell spreads on over and over again under key resistance levels. And then, if necessary and if applied, we would be able to generate 100% on our return by doing that trade 5 or 6 times a year rather than trying to speculate on a low volume option to the upside, low probability of profit option to the upside. So the key thing to keep in mind here when you're looking for these names, 20% return out 45 days, maybe out 60, and probability of profit in the 80% range. I'm trying to keep up with you guys in the chat. I know you guys have a lot of questions about what's going on. Thank you for joining us, LeBlanc. That is appreciated. All right, on the downside, PayX and Starbucks, and we're going to look at some 15-day moving averages on that as well. Paychex technology, it's just the application software names. And we've talked about this for the better part of a few months. This really is tied back to the problems in the job markets, software application names. And really the question becomes, when will these stocks actually start to rebound? If these stocks start to rebound, that may signal that the market is expecting the bottom of our job market woes. But for the most part, if these equities are forward-looking indicators of demand, particularly linked to job markets, or, in the case of workforce enhancement technologies like Monday, if these things are still selling off, that is telling us that there is still more expected weakness in the U.S. labor markets heading into next year. So PayX, what we're looking for is a continuation of lower highs and lower lows. We had a recent spike up here, a revisit back down to the 108 level. These can be very expensive to trade. Obviously, there's been a lot of volatility around these names. Short floats around 4%. a lot of indebted names. Some of these stocks are zombie stocks. And if it cannot get back above that adjusted EMA of 100, that 100-day EMA, that's a 100-hour line right here, looking for a continuation in trend of lower highs and lower lows. Starbucks, which we have not gone to on this trip somehow. Starbucks is currently chopping around at the moment. 15-day EMA, very critical here. If we see weakness in the consumer cyclicals return, it is buying up here in the money and selling out of the money down here on a put spread and looking for a move down to at least 85 relatively quickly. 87 to the 85 out for something like next week would be an easy trade. But again, it does largely come down to questions around momentum and what is going to be happening today. If we got back up to 88, that would be where I would take my next shot at another move down, simply because we're coming off this short-term squeeze and Starbucks has not changed its fundamentals or improved in any capacity. I still don't like the stock. I still think it's moving to newer lows in 2026. All right. Friday watch list. Well, once again, go back to what we know and we know well. We know NVIDIA, which is coming off the point of a uptick in its higher channel. Lower highs, lower lows on our 30 and on our hourly. And this is how big stocks move when they are being dumped by funds. They don't just go all at once like they did on like a single day in April. Typically, there is a period of lower highs, lower lows, and then we finally start to actually get the capitulation. We're not seeing that yet. We're seeing a continued pattern. And my next move down on this is going to be somewhere around the 186 level. So if you're looking to short NVIDIA and it cannot stay above or get back above that 3,000, yeah, 3,000 minute line, that green line right there, NVDQ becomes the short fund that you would utilize. Effectively, what you can do on the short term is speculate if there is an options chain or simply buy the NVDQ for a few days. And if it stays back above that key 50-day EMA, you're looking to ride it higher just in case you get that capitulation candle on NVIDIA that so many people have been predicting has not come yet. But once again, this could be a relatively sizable move. We've seen big moves on the NVDQ when the markets throw in the towel on a particular equity or just the broader market itself due to a breakdown in momentum. With momentum positive right now, NVIDIA is still beaten up. Technology is still negative, and we will watch this on volume weighted average price. And of course, look for the pattern of NVIDIA's lower highs, lower lows to be reflected in positive movements on the NVDQ of higher highs and higher lows. Right now, there's your line in the sand at about 1824 on the NVDQ. Buy it, hold it, effectively trying to trade it through today. If it moves to 1825, you're out. But if NVIDIA resumes its selling, a move to 21 next week, certainly in the cards. 10% move against about a 2% move is your bet. Google, which continues to not defy logic, just continues to see the inflows associated with a company that is replacing another company in terms of inflows in the market. Higher highs, higher lows for this stock going back a couple of weeks. Obviously, the bullish nature of what happened with its in-house chips combined with Warren Buffett providing additional support. I do like the idea here of simply buying in the money on Google options, call options, and selling out of the money, creating a call spread and using a tight stop just in case this market does roll over. So bullish on Google, bearish on NVIDIA. Coinbase is going to be at the mercy of Bitcoin, but we've seen continued strength, higher highs, higher lows coming out of that momentum move. And it is a reminder that when we get a positive shift on momentum or we get any sort of stimulus out of a G7 nation, it is bullish for crypto. Therefore, it is bullish for Coinbase, looking for a continuation and a possible move back to 305. And finally, I said it the other day, rig, Transocean. The stock just continues to keep moving higher, higher highs, higher lows, very strong fundamentals. These numbers are off. This has just been one of those smaller number names in the upstream space that just continues to churn higher. So one idea was to sell spreads to the downside, but this is likely going to continue its pattern of lower highs, lower lows. Forgive me, higher highs, higher lows as we proceed. Your line in the sand for this will be back at the 420 level for rig. If it does drop back down, we would look for a negative momentum move, revisit maybe a 390, and then buying back in for continuation, looking back toward a 450 target from there. All right, it's 9:12, which is very exciting, which means we have 8 minutes left together. So let's get through a couple of other things before we head into this trading session. Remember, today is a very short trading session. We wrap the day up at 1 o'clock, which means everybody here at TheoTrade will get 30 minutes to make their best pitch for December. Don will be coming up first today. If you haven't seen the schedule, it is an abbreviated schedule that we put in the chat a little earlier. Don will be here at 9:20. Then Jeff is coming in at Jeffrey Bierman will come in at 10 o'clock Eastern, Gianni at 10:30, Blake at 11 o'clock, Brandon at 11:30, Tony at 12, and Corey to wrap up the trading session today at 12:30 to 1 o'clock. So everybody on stage for 30 minutes today. Market is leaning once again on December rate cut hopes. The rate cut probability for December does keep rising. If you don't keep an eye on this, this is the CME Fed Watch. This is basically a likelihood of a rate move based on implied volatility on the 30-day Fed funds futures prices. That's probably not right. Probably not based on vol. Probably just based on I got my dogs in here now. Okay, my family's just sitting here staring at me talk, including my dogs. This is very awkward. You be quiet over there. Stop it. Okay, 87% probability of profit. Did not expect a live audience today, and very, very intensive experience. I do not recommend it. For December 10th, 87% probability, 13%. We move out into January, and we start to see that the odds of another rate cut start to arrive as well. So this is kind of how the shift starts. And if we go out to all the way next year, people are pricing in the possibility of under 2%, which would signal a shift in Federal Reserve policy and the likelihood that Haskett is running it and not Jerome Powell. TNX, we are looking at as well. TLT, ZN, SPY, Qs. Watch the XLF, the XLK, and the SMH. A reminder heading into today that we had 5 sectors that are currently positive on our S&P 500 readings. This is not just the individual sector ETFs, but also moving down into all of the shares and stocks in the broader financial markets. Basic materials, energy, healthcare, real estate, and financials. And it is a reminder that I want you to remember this every single time that I say it. Any time that a Western central bank or Western nation engages in actual stimulus, Japan is one of them. The European Central Bank is one of them. The Bank of Canada, the Bank of England, the Federal Reserve. When they engage in stimulus, it is beneficial for all banking stocks in the United States, particularly at the upper echelon, the larger names, the JP Morgans of the world. Just saying. So the XLF had a nice little pop coming off the 21st. Looking for a continuation of this run, but we did see, again, some pretty intense selling that transpired. Now, look, came in. People took profits. That's the purpose of the market. We still saw some broader selling on the Russell, but XLF, all of these things are very critical to keep in mind. Monetary stimulus out of the West, bullish for gold and silver and nat gas. WTI. Just very strange. It's very awkward. All right, we're gonna keep going with this. Uh, Sorry, my dogs are growling. Gold continuing to move. Fourth straight month, gold jumping to a 2 week high and closing its fourth consecutive monthly gain. Remember, everybody said that gold was going to collapse back to 3,000. It did not. Why? Because all roads point to more monetary stimulus. Very important thing to remember. So, all of those names, the Barrick Golds, bringing back in things like PYHS, bringing back in things that are linked to the gold miner ETFs, the GDX, right? Back above these moving averages. Don't be afraid. Put spreads are your friend. 80% probability of profit, 20% return. Looking for a continuation in price, even if gold just stays sideways. Selling spreads on the miners that have shown incredible margins this year remains a good play. If you are a person who likes to speculate a little bit more, you're day trading gold, you've got the GDXU. A move back to 280 is back in the cards, but we just need to see liquidity improvements. SI and silver as well, and the UUP and the DXY watching the dollar. Finally, gold Black Friday and the consumer holiday retail season to begin. Have not seen any news yet about any bloody noses over televisions, but I'm sure those will come. We're looking for signs of a tapped out consumer. Again, Amazon continuing to dominate online e-commerce, dominating, showcasing the shift of consumer preference and consumer trends. Amazon will be busy today as a stock, so will Walmart. Remember, options expiration today. If we see pullbacks, look for an opportunity to buy back in. Look for an opportunity to ride some momentum on some of these equities, pushing above volume weighted average price or some key moving averages. Just to day trade some of these names and get used to understanding how to take advantage of in the money options that expire today rather than trying to trade the underlying stock. But once again, today with the temporary freeze on the CME, expect some wide bid ask spreads, monitor your positions, and most of all, here's another important thing. If you have stops on certain positions, be aware that something could go a little bit haywire. And if it goes haywire and the underlying equity drops and it triggers that stop, and then there's a V-shaped recovery, that's kind of a fat finger environment. So just be aware of what you have set up and just recognize that you may want to temporarily pull something off in the next 10 minutes just to ensure that nothing does go haywire on a day like today. And since it is Black Friday, remember, we are still here. So we have Garrett Baldwin Theo credits. Turn a dollar into $2. $2,000 credit to any of the masterminds and trade alert services. First come, first serve, strict limit of 2 credits per person. It's your last day, everybody. 623-244-5657. Use code word Garrett. And once again, win a Falcon F10 trading laptop. Get your credit today. 623-244-5657. 2 R's, 2 T's in Garrett. Opportunity for a $1,500 laptop. Guys, I hope you all have a great trading day. I hope that you had an awesome Thanksgiving as well. I will be back on Monday at 8:45 from my studio, not here with this live audience of dogs and brides and snoring brothers-in-laws. Everybody have a great day. Take care. Don is up next.